Hello, traders, and welcome to this new webinar. Today is another webinar presented to you that aims to, uh, let's say, give you the most important tools that can help you in trading to be in a better situation where you are able to understand the movements of the market and get benefit of every thing that could work for you. So in this webinar today, if you are sick of charts overloaded with indicators, then the following talk would be very helpful to all of you. You will, I think, by the end of this webinar, you will be able to view the markets in a simpler, more effective way. So I will simply walk you through the most classic way of trading. It is simply a price action trading system. So today we will go through the most important aspects of a price action trade, and we will examine a few price action trading strategies together. So first of all, what is price action trading? What is price action trading? So let's put it this way. I'm gonna open a chart here and I'll let you see this yourself. Here is simply a chart of the Euro USD. This is simply a currency pair. So the chart here reflects what's happening between these two currencies. I mean, think of it like a war between two opponents. So let's put it this way, just a minute. So we have here, for instance, as you can see here, just a minute, guys. So here we have Euro USD. Okay, so we have two sides. Let's say two opponents. Okay, Euro USD. This is how it works. I think I need to use a larger font size because this seems to be a little bit small. I think I need to use something that is, yes, there you go. So let's put it this way, Euro USD. Okay, there you go. As I told you, we have two opponents here. We have two opponents, and this is war, and this is their ring. This is their ring, actually. The first one here is Euro. It's called base currency. This is base currency. The second one is called counter or quote currency or counter currency. So there's a fight between these two ones. Who is going to win? This is the question that you're going to ask yourself. Who is going to win? If euro is gaining value, is simply beating, is simply fighting the US dollar very, very, very strongly, in this case, you're going to find that the chart is going upwards. See? In this case, the chart of the euro dollar, you're going to find it going, raising, it's going to increasing in value. Why? Because the euro is gaining value against the American dollar. On the other hand, if the US dollar is gaining value against it and the euro is not appreciating against the US dollar, in this case, you're going to find that this chart is decreasing or is going down, is falling as a result of this fact. So this is what's happening almost all the time. What we're trying to do here is that we want to simply understand how it works and when the euro is going to gain value against the American dollar, so we can take its side. We can simply trade with the euro and have a position earlier before the euro stops going upwards. So we want to join the market as early as possible. In this very case, we're gonna use what we call price action trading. Price action trading is simply a method. You must be muted, guys. So make sure that your microphones are muted. They are on. They were on actually. So price action trading in the FX market, to be exact, and this could be applied in other markets, is a trading method based only on analyzing previous price behaviors. So how the price behaved before, because we have a concept in technical analysis that is history repeats itself. What happened before might happen again in the future if the same factors that caused it in the past happen again in the future. So just think of it like this. This means that a trader would analyze market conditions on a naked chart without using additional indicators or oscillators. So this could, I would call it like the purest way to evaluate the market, and certainly the most effective way to trade that I have found myself. So price action trading would help us with the following that I'm gonna explain later. But let me show first of all what a naked chart is. So a naked chart, you're gonna open your chart like this. Okay, so this chart just has just this is the purest action that could be seen ever, because the chart does not include any indicators, anything, just the price action itself, the price itself, nothing more than this. These small components, we call them like candles. We call them candles. They have some wax, these shadows to the upside and to the downside, and there is a small body here, could be larger than this, could be smaller than this. It depends on the volume of the market, the momentum of the market that would form these movements. So based on this, I believe we can start from this point to see how benefit it is to use pure price action. I mean, what are the things that would the pure price action would give me? So first of all, pure price action or price action trading would help me to identify trends. So trend identification is going to be your very first thing. We want to know when the price is going upwards or going downwards. Is it going up or is it going down? It all depends on the market conditions. So first of all, we have trend identification, and this is going to be, maybe I want to go to my whiteboard to write this down for you. So we have here trend okay, to identify your trend first of all. Okay, so this is going to be the most important process in a price action trading strategies. To identify trend is really, or the ongoing trends is really very important. You probably have heard the famous phrase, the trend is your friend. So this is going to be like our cornerstone, you would say. The trend is your friend. Just follow the trend and you can make money. This is how it works. So trend identification, the trend is your friend. And this is absolutely correct. The trend is your friend. You should always try to trade in accordance with the privilege trend whenever possible. Sometimes maybe you have a main trend. Let me clarify this for you just a minute. Maybe we have an uptrend. The uptrend, I mean, the market does not move in a straight way to the upside or a straight way to the downside. It doesn't go this way. The market goes or moves in a zigzag manner like this. Sometimes, I mean, during this uptrend, if you focus on, if you go to a lower time frame or something like this, you're going to find that the movement of the market uh, is built up like this, ups and downs, ups and downs. So it's not a straight line to the upside. It doesn't go this way. Nobody can tell you this. The thing is that you're going to find sometimes that the market goes downwards, and this is acceptable. This is a correction. This is a correction or an opposite movement to the other direction, to the downside, just like this. So the main trend we have is an uptrend, and then the market goes against the uptrend. This is acceptable. This is called a corrective wave or a correction, whatever that you want to call it, just a movement in the opposite direction. And this would build up what we call a trend. And the same could be applied on a downtrend. Whether if even if you have a downtrend like this, it would be build up from small waves. If they are not the, I mean, if you're gonna have like maybe a downtrend like this, you're gonna find that we have small waves in the opposite direction to the upside that would build up this downtrend line. So let's say 50-50, you're gonna find maybe if this wave is made from like 10 waves, 5 of them would be to the downside, 5 of them would be to the upside. But the major or the main power that would control the market by then would be the power of bears or sellers. Okay, so this is the first thing. The second thing that would be very beneficial to all of us by using price action is avoiding consolidations. Price consolidation is simply when the price is ranging without any clear direction, just like this. Let me clarify this for you. So if the market if the market is going sideways like this, just like this, sideways, it doesn't have a clear direction, and this sometimes would be like a pain in the neck, because you don't know when the market would whenever there will be like an explosion, when the market would continue its main direction, or when it's gonna get out of this very boring range. So this what makes it very difficult. Okay, so guys, before I carry on, do you have any questions on this? Before I carry on, do you have any questions on this? Both are valid. Both are valid. The thing is that it depends on you. You must identify yourself. You must know yourself as a trader. Are you a weekly trader or a daily trader, or maybe an intraday trader, a daily trader? I mean, it depends on you. If you're gonna trade the weekly, then you just trade the weekly. If you're gonna trade the daily, you just trade the daily. Uh, this is how it goes. Maybe you can take the bias from a higher time frame, like the weekly, the bias from a higher time frame like the weekly, and you're gonna go to a lower time frame like the daily or the 4 hours, or maybe you're gonna maybe trade the daily time frame, and the bias on the daily time frame is, yes, could be. The 4 hours could be your bias when you're an intraday trader. So if the 4 hours is like very positive, and we have a strong uptrend. You go to a lower time frame like the 1 hour or something like this, and try to catch um, the waves in the opposite direction, the corrective waves, the corrections to the downside. And then once you see that there is a clear, let me give you an example on this. I think this is going to be much better. Say that you have here, I didn't really prepare for your question, so I don't have something on the chart right now, but I'm going to clarify this as much as I could. So if you have, this is going to be the 4 hour, the H4 time frame, H4 time frame, or the 4 hour time frame. Okay. As I told you before, that the market does not go to the upside or to the downside in a straight way. It doesn't go this way, but the market goes in a zigzag way, ups and downs all the time. So the main here is, the main trend that we have here is bullish, right? So you're gonna find that the components of this huge movements, the small waves, are uh, are going to be like this: small waves, small bullish, small bearish waves. If we focus here, if we zoom in here a little bit by going to a lower time frame, maybe here at this very point, we want to catch the movement here at this point here. We want to catch the movement here at this very point. So when the market reaches this area, for instance, this is going to be a fair gap value if you are going to follow ICT methods or something like that, or whatever. So you're going to wait for the market to reach this support level, and then based on this, you can enter the market. So the market reaches this support level. A support level is very, very, is a very strong area during an uptrend. I mean, it's not easily broken like resistance levels. Resistance levels in an uptrend are very easy to be broken. Okay, so I hope this would clarify the thing, but I think a practical example would be much better, but I didn't prepare for it for this to be exact. So as I told you before, that one of the benefits of using price action trading is that it would simply tell us when to avoid consolidations, ranging without any clear direction. This means any clear direction in the market. So this means that the price of of a specific pair is not increasing or decreasing. It just goes sideways, just like this. Okay, so here is what the pair would gain here, lost here at this point. So here starts the movement to the downside. Then it's gonna lose everything that it gained before here. Then it's gonna gain again, and then it loses whatever that it gained. This is simply how it works. So it's rather we could say moving sideways, and usually not providing any high probability trading opportunities for most traders. I mean, many traders would think of it like this: a good trading rule would be to stay out of the market when the price is consolidating, in order to avoid anything that could simply make you lose money. Sideways movement is okay for some people, but not for everyone. You're welcome. One important thing that we could talk about is finding reversals. Some traders tend to attack currency pairs when trend lines are getting exhausted. The reason for this is that trend reversals give you the opportunity to beat the market right at the beginning of a trend. This is the thing. So if I have, as I told you before, I mean, if maybe this could be the 4 hours. For you, this could be the H4. If we zoom in, if we go to a lower time frame like the 30 minutes, this could be a huge uptrend. Here at this point, this could be a huge uptrend. So you go to the 4 hours, the bias is the market is ranging, and here I'm ready to enter the market when the market reaches this area, because this is a consolidation, a sideways movement. So when the market reaches this on the whatever the 30 minutes or something like the 30 minutes time frame or something like this, you're gonna find that the market here is reversing, and this could be a trend itself. This could be an uptrend. So from this very point, I'm gonna enter the market. I'm going to place an order here because I expect that the market would continue going upwards, just because that I'm having here a consolidation, a sideways movement. So this simply can help me. So finding reversals could go this way. The reason for this is the trend reversal gives you, as I told you, the opportunity to be in the market at the very, very, very beginning of a trend. So when looking for reversals, traders try to enter before the crowd does in order to maximize the potential reward to risk ratio offered on such trades. Okay, and you could also, I mean, just look at this from another perspective, from another aspect. Like when the market is simply heading upwards, you want to analyze corrections. As I told you before, when the market is heading upwards, you're gonna face, the market is going to encounter some movements against the main trend. The main trend is bullish, but sometimes you're gonna find that the market is going against this main trend. So in this case, you want to catch these small movements, and you make sure that these movements are going to end very soon, because the market would continue its main direction. The main bias, as I told you, is going to be bullish. So I want to follow buyers. I want to follow bulls in the market who are dominating right now. So this is simply how it works. So do you have any questions on this before I carry on? Next is going to be very important. We're going to talk about some how to identify support and resistance levels, how to identify trend lines. Maybe if we have time, we can add more than this. We can go further. So let me know if you have any questions. Okay. So let's continue here. Now, there are some important tools. I would call them like cornerstones. You can be a trader. You can't be a trader, a price action trader, without understanding these important, without understanding how to use these important tools. Okay. So first, first of all, we have what we call support and resistance. Support and resistance. And this, I mean, support. We're going to apply this on the chart. gonna be very important, the practical part. I mean, it's more important than the theory, I believe. Okay. Okay, nice. There you go. We have support and resistance levels. Generally speaking, I would say that support and resistance levels are horizontal lines. They would look like this on the chart. Would look like this. Okay, they would look like this on the chart. Okay, we have two axes on the chart. Actually, we have the price axe and the time and date axe. Okay. So if the market, guys, goes like what we're trying to do, I want to think of it like as if as if you're trying to find a station where you can, I mean, think of it like this. There is an airport and you want to travel from this, you want to move from this point A to B. The only transportation, or the only thing that could be taken to move from this point to this point, is a plan. So in this case, you go to an airport. This is your station. From the airport, you can take your plane. You can have your ticket, and then you can move from A to B. So these levels are adopting the same method or the same idea. So these levels are drawn based on the previous uh, action of the market, the previous, how the market behaved before, how the market moved before, and you can simply draw these lines on the chart, horizontal lines. When the market reaches this area, you can take an action. You can simply buy or sell. So they are very important because they are stations. They are simply stations or airports where we can enter the market. This is the easiest definition that you could that I think that you could understand. So okay. Okay. So support and resistance are on the chart levels where the price is expected to react. These are usually psychological levels where investors' attitude tend to match. These levels are easily spotted on the chart when you see the price attempting to go through a certain level several times, but is met with buying or selling pressure. Then you have a psychological level. If the price approaches this level in bullish direction, the level is a resistance. If the price is simply is approaching this level in a downtrend, then this is a support level. Let me give you an example on this. On gold, actually, gold has now has is trading below a very strong resistance level, that is 2070, which is this area. I think you can see the chart right now. So this area is a very strong area of resistance. Look at this here. How many times the price did touch this area? Look at this: one, two, three, four. Here's gonna be the fourth time. The fourth time is weaker than the third. The third is weaker than the second. The second could be the strongest touch, actually. Uh, and sometimes there would be like manipulation that the market goes above a certain level, then it goes back just to hit your stop loss, and then the market goes in the main direction again that you intended to enter. Anyways, this is another topic to be covered later, maybe. So the market, I think, is going to continue more and more until it reaches, I believe, 2070, which is this area of resistance. And from there, we can simply go short, I believe, if the market shows up bearish evidence. Now, when I was giving you an example about going to an airport to take a plane, you must have a ticket. This is going to be your ticket. The evidence that could be seen, that could be showing up below a specific level like a resistance level, this is going to be your ticket. Without this ticket, you can't enter the market. You know what I'm saying? So if the market reaches this area, I'm going to be watching the market. I keep an eye on these levels. If the market shows up bearish evidence below it, like a candle, a specific candle, a specific reversal candle, I'm going to enter the market. I'm going to go short. Other than this, I'll be just watching the markets, because the market could change its mind and continue going upwards for manipulation. I don't know, for some fundamental reasons, some fundamental drivers. Nobody knows. But the thing is that we're just depending on evidence here. So this is something that can show you how important a support or a resistance level is. For instance, I would not go very far away. Look at this area. Here we had a strong support level at this level. You could catch an opportunity here around 1807. I mean, if I go to a lower time frame, I'm going to show you some advanced techniques where you can enter the market at this point. For instance, we had a base here and a breaker here, and the market goes up above it, and then it goes back to fill this gap, this area. Look at this area here. We had a fair value. Sorry, guys. Here we had a fair value gap. The market did touch this area and then boom to the upside, as you can see. These are more advanced techniques that could be used in analyzing the market, but you can't go further than this without understanding, unless you understand uh, um, um, support and resistance levels, trend lines, and so on. These are the measures or the cornerstones of any trader that wants to improve themselves. So that's it. So I just want you to know that every support can be broken and then turned into a resistance. The same could be is true when it comes to resistance levels. Any resistance level could be broken and turned into a support level. So this is how it works. How can you draw a support or resistance level? There are two things in the market, I think, um, worth mentioning. So we have here what we call peak and what we call trough. Look at this, guys. This part, the highest point is called peak, or high. Peak or high. And this one is called low or trough. This area. See? So when the market reaches, or when the market forms one of these things, on these points, you can draw your horizontal lines. So I'm ready to draw support and resistance. Yes, you're ready to buy, to draw support and resistance levels, just like this. If you draw a line like this, you have support and resistance. Which of them could be called a support? Which of them could be called a resistance? It's all about where the price of the market could be found now. If the price of the market is above one of these levels, this is called support. If the price of the market is below one of these levels, this is called resistance. Again, the only norm, or maybe thing that you must be focusing on, is the price of the market right now. If the price of the market right now is above one of these levels, here is the price of the market right now. So all of these levels are support levels. If the price of the market right now is here, all of these levels are resistance levels. That's it. This is the easiest way to explain support and resistance levels. Let me go back here. So resistance level is a horizontal line. Okay. Could be drawn just above a peak or below a trough. On only one peak, it needs only one high or low. Okay. On which you can draw your lines. Maybe your levels would be much better. Okay. It's all about what? Must the price is above, below. The price of the market, the live price of the market right now must be below this level. In this case, I would call it like resistance. ماشي? Okay. Support level, on the other hand, it needs only one high or low on which you can draw your levels. The price of the market is above. You know what I'm saying? So I think I need to use I'm changing it. The line width must be bulky a little bit so you can see it. Okay, just like this, just like this, just like this, just like this. Here's the price of the market. So all of these things below are considered to be support levels. Okay. The resistance. So all of these things are considered to be resistance levels. That's it. This is how it works. I think, guys, we're running out of time, so there are many things to be explained today, but I think we won't have time. Anyways, so as for this, let me show you some examples. I'm going to open a naked chart like this. Guys, there are many things to be covered, actually. Uh, so I'm sorry for running out of time. Now, what you're gonna do, there are specific steps to for you to follow. Um, First of all, ask yourself one question: where is the current price of the market? Here is the price of the market right now. Okay. Then from this point, from the current candle, okay, that is operating right now, you go maybe a little bit downwards to catch levels that could be found below or above. So, for instance, this level, as you can see, here is a an inverted. This could be. This looks like V shape, V shape, right? Right. So just below the V shape, you're gonna draw your line. Another one here. Another one here. I think three ones are enough. I go to the upside. I want now those ones are support levels. I go to the upside. I don't find anything here, so I go back, farther backwards. Nothing wrong with this. Here and maybe here. Next, what you're going to do is to wait for the price to reach one of these levels. If the price reaches a support level, this is where you could be thinking about going long. This is where you could be thinking about entering the market, about going long. If the market is reaching, um, if the market approaches like a resistance level, this is where you must be thinking about going short because sellers or maybe let's think of it like this: the crowd would be thinking the same way that you do because you are thinking that the market is going to reach this resistance, and from there are many people who would sell, so they're gonna sell. They are adopting the same methodology, they're adopting the same thing. They know that there is a strong resistance. A resistance level is where we can go short, so most traders would think the same way. Okay, guys, so I think you are ready to go right now. I mean, it's a very important thing where you can what you can where you can apply. Okay, guys. So do you have any questions on this before I carry on? Okay, so let's carry on. Let's move to what we call trend lines. Trend lines are tools that could be used uh, uh, to be used the same way like support and resistance, but they have a slope, they have a direction. Um, Let me go back to my whiteboard. Now, Trend lines would simply look like this. We have up, we have either uptrend or down trend. Now the thing is that plus line here, plus line. Okay. So if you have an uptrend is simply a movement to the upside where buyers are dominating, buyers or bulls are dominating the market. You're going to find that the market is going like this. And the width of the line is very thick, very thin actually. I think I go to the bulky would be okay. So here's an uptrend. Now there is no line. There is no line. And here is a downtrend. We also have no line. The line is something that would create that, or that would form a station where you can enter the market. So I'm going to use a line. The line is all about the fact that you must spot 2 points. They would build what we call a trend line. So when it comes to uptrend line, we need 2 higher lows. 2 HL. HL means higher lows. Downtrend, we need at least 2 lower highs, above which we can draw our line. Uptrend, below which, so below the 2 higher lows, we can draw our lines. Here above 2 lower highs, we can draw our lines. Okay. So I'm gonna pick my tool here. I'm gonna connect the 2 higher lows together. You're gonna have an extended line to the upside like this. That's it. This could be applied on any time frame, on any currency pair. The same thing, the same is in force for the support and resistance levels. Okay. I mean, support and resistance levels could be drawn in any time frame on any currency pair. The same is in force for trend lines. The same is in force for candlesticks, for any patterns that would be explained later or be covered later. So I'm gonna pick my tool here, and that's it. I only need 2 points. 1, 2. Here, 1, 2. That's it. This we said. I mean, we explained before that a support level could be broken, and could turn into a resistance level. A resistance level could be broken and turned into a support level. Trend lines could be broken and and there is something that's called the rollover. This is when a support level is a resistance, and when a resistance is a support. That's it. So just look at this. The market goes below this level, it is broken. The uptrend line is its nature is support. It has the support nature. The resistance level, sorry, the downtrend is resistance. Okay. So an uptrend line has the support nature. The downtrend line has the resistance, has the nature of a resistance level. So the same thing could be applied here. Nothing different. The only difference is the fact that trend lines have a slope, have a direction, okay, but could be broken when the market reaches a support, an uptrend or a downtrend. An action could be taken, like going long or short, and that's it. Let's go to our charts and see what we have. For instance, this is a support, a downtrend here and here, and the third could go, you could go short here, broken, so the scenario would change here as well. Look at this. Breakout, the market retest the broken level, then it goes down. Here, smaller one. Here. 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 So there are many actually. So that's it. This webinar has been recorded, so you can find a recorded version or on our website or our YouTube channel. So you have a reference later. You can get back to this. You can watch it later if you missed anything of importance. So I hope this webinar was beneficial to all of you, that you have learned something. Hope that you have enjoyed the webinar of today, guys. Stay tuned for our upcoming webinar, and bye for now.